gets you all the top stories of the day. I'm Kritika Saxena. Here's what else we have lined up for you today. The top story this evening, a major step in the war against bad loans. The RBI has empowered banks to go completely for the kill. Lenders can now convert their loan dues into equity provided the majority agree with such a move. To break this up for us, we have Lata Venkatesh joining in. Lata, how significant is this step? Break this up for us. What does this mean going ahead?
Well, this clearly is a very big step that will empower banks in cases where company promoters are either not meeting the debt revamp standards or are otherwise unwilling to bring their part of the money. At the moment, loans are restructured under two windows, the corporate debt restructuring window or the joint lender forum. The joint lender forum is a more recent requirement or invention by the Reserve Bank. What the Reserve Bank is requiring by these set of guidelines announced today is that in all cases of restructuring, the lenders, that is the lending banks, should include a clause saying that if the conditions or if the milestones mentioned in the debt revamp within the time frame are not met by the promoter, either sales guidelines or profit guidelines or EBITDA milestones are not met by the promoter or the company, then the banks have the right to convert their loans into equity, thereby get a majority equity jointly on the company and have the right to find a new promoter. So these clauses will be prospectively included in the debt revamp, either under the corporate debt restructuring scheme or under the joint lender forum schemes, and henceforth it will not be very easy for promoters to get a debt restructuring, not meet the conditions, then go for a fresh debt restructuring. That will not be possible. If they don't meet the milestones, the banks will be able to compulsorily convert the debt into equity. Of course, such a clause will have to be approved by the shareholders of that company. So it's a new process that will take time. We will have to see how it progresses. But clearly it empowers banks to just, brush away unwilling or badly performing promoters and acquire control of the company, find a new promoter for it, and thus recover the loans that they have invested. The RBI's, guiding principle for some time now, at least in the past 2-3 years, when it has announced these joint lender forum guidelines, has been that when a company sinks, the first hit should be taken by the equity holder. At the moment, very often it is getting, the hit is being taken by the banks who are the debt holders. Since a bankruptcy law is not there in India, this scheme will hopefully function till a good bankruptcy law comes in. Well, we have a few bankers who will be speaking to us about this new strategic debt restructuring scheme, as the RBI calls it. Joining us now is Mr. Rajneesh Kumar, the Managing Director of State Bank of India. We will also be joined by Mr. Ashwin Parekh, a long-standing expert on banking and now Managing Partner at Ashwin Parekh Advisory Services. Mr. Rajneesh Kumar, to you first. Do you think this immediately empowering the banks enough to take control of companies? This is only going to be prospectively applied, right? Won't be applicable to CDR cases done so far.
Right. Lata, I think the way...
Yes?
The way it is being put, I'm seeing your headline, banks to go for the kill. I don't think that is the intent and purpose of the whole thing. What the circular speaks about is an enabling provision, right? And when the existing promoters, for some reasons, after the initial restructuring, have not been able to give the desired results in terms of performance, so what are the options available to the lenders? Either go for enforcement action, call off the loan, go for restructuring, which doesn't help anybody. But through this process, if everybody sits at the table and sees the reason that there which is required to revive the unit, and anybody who comes in, definitely they will be looking for a majority control. Nobody would come and put money on the table unless they have 51% equity in the company.
Yes.
But finding a new buyer or someone who will put 51%, it takes time.
Yes.
So the whole process, that's what the circular RBI guidelines speak about is that as soon as it is found that the milestones are not being met, then immediately you convene a JLF and decide whether we are going for this option or not.
Okay.
So it has to be evaluated.
Okay.
Then there is a 90 days period for approvals. And another 90 days to find a buyer and convert this share into equity and start the whole process.
Okay.
So according to me, these guidelines can create a win-win situation for everyone.
Yeah.
Even for the existing promoters.
Yeah.
Because even if 51% equity goes to a new promoter with the control, but existing promoter may decide to hold on, say 20%, 25% or 15%, and if the unit gets revived, so automatically its enterprise value goes up.
Yep.
And minority shareholders gain, lenders gain, existing promoters gain, and the economy overall gains.
Okay.
So that is my take on it.
Okay. What I wanted to ask you is that this will not be allowed, or this is not applicable for cases that have already been restructured so far. For instance, say Bhushan Steel has just been restructured, or other cases. In those cases, banks are not similarly empowered. If, for instance, Bhushan Steel doesn't meet its milestones, you will not be able to convert the debt into equity?
No, we will be able to convert the debt into equity.
You have the clause there?
No, if we don't have the clause, that clause can be again, as I said, because it is in the interest of everyone. So this clause, because it requires disposition resolution.
But the restructuring is closed, isn't it? It is over. Why will the promoter agree for a case where he has already got a line of credit?
Right. So, but still, if he is unable to revive, what are his options?
All right.
You tell me.
If he is unable to revive, there is a chance for the banks.
Unable to meet a milestone. So, what are the options? Options means then the company goes into surfacey or liquidation or this thing.
Yeah.
And that's why I'm telling that the scheme, the spirit is that everybody sits down and work towards a resolution which helps everyone.
Okay.
So I don't think that even if there was not a provision, in fact there is a provision.
Yeah.
Already whatever master restructuring agreement are entered to at the time of initial restructuring in CDR and JLF, there is already a provision there. But presuming that that provision is missing, still it does not stop here.
Okay.
And by mutual consent you can have a special resolution and the consent of the existing promoter.
Yeah, but it will take time, isn't it, Mr. Rajneesh Kumar, for even those loans that are under the joint lender forum at this point in time. It will take time for the company to go back to its shareholders, because the guidelines clearly say that this conversion clause should be authorized by a special resolution of shareholders. Will all this be possible? If there will be too much back and forth, will you be able to respect that 90-day deadline?
90 days, so overall you are getting about 7 months, 30 days for you to decide whether you are going for this option or not. 90 days is where the lenders take their internal approval.
Are you sure shareholders will approve it?
No, if they see value in it, they will approve it. If they don't see value in it, and if they don't approve it, as I'm saying, then the enforcement action comes in.
Okay.
Because banks have ultimately, we have to see that whatever is the future of the unit. If a restructuring package has not worked for, say, it has not achieved milestone in 12 months, then what are your options? Your options are either lenders then call off the loan and just straight away go for enforcement. What do the shareholders get out of them?
Fair enough.
Then the lenders dues, they will get the precedent, and it is a complete loss to the shareholders.
Okay.
So that's what I'm saying. It will have to be evaluated.
Okay.
And in any transaction, any deal, we have to have a situation where there is something for everyone.
Okay.
So minority shareholders, if they feel that by this action, somebody white knight is coming in, willing to put money, ability to revive the unit, and it may be in their own interest, like if after 12 months unit revives, so everybody gains.
Okay. Yeah, even as we were speaking, there is some breaking news coming from Tata Steel's United Kingdom trade unions. I'll just allow Kritika to update you, and we will be back with Mr. Ashwin. Mr. Parekh, we've been speaking with Rajneesh Kumar, the Managing Director of SBI, and Ashwin Parekh, Managing Partner at Ashwin Parekh Advisory Services, on the new rules put out by the Reserve Bank, which empowers banks to convert their loans into equity and change promoters of companies that are not able to pay back loans. Mr. Parekh, this is only going to be prospectively applied. Do you think this is going to reduce the burden of NPLs, that you will find promoters more willing than they have been so far?
Well, basically 2-3 things. One is, of course, this reform, conversion of lenders' debt into equity, something we've been talking for a while now. So in some sense, I'm glad that at least the first step is being taken, in the sense there has to be some beginning.
Okay.
This is conceptual to my mind. There are a lot of practical issues which both the lenders and the borrowers will have to really go through in this process. The first and the foremost, let me quickly articulate. Let's say it presupposes, for instance, that the shareholder has already, the existing borrower has already accepted the fact that he will not be able to, despite the fact that he may not meet with the milestones, that is acceptable, to the idea of giving away the management or giving away the equity, 51% of the equity to another buyer altogether. Banking companies will only act as intermediaries in this process. Now, this is a huge hypothesis or a huge assumption. How far will it really pan out is something that has to be seen. That's
Sorry?
one. How far will it, how far will the promoter readily agree, Lata?
Yeah, but if they don't agree, they will not get a further line of credit, isn't it? The bankers can forcibly drag him to SARFAESI.
Yeah, no, I agree entirely. But, in the past we've seen that in order to drag, you need a lot of sort of interface with the JLF members.
Okay.
So far, whatever we've seen out of JLF, will they be able to reach that hard-hit decision is one question. The second is, I thought somewhere along, even if he does agree, then once again, the matters can stop at valuation. At the AGM, for example, if the shareholders, or the EGM, Extraordinary General Meeting, let's say, which is conducted, if the shareholders expect a certain order of valuation of the business, then once again another set of issues come up. And the ability on the bank's part to identify a buyer in that situation is also another issue.
Fair point. Mr. Rajesh Kumar, we are running out of time. So your reaction, do you think it is going to be easy? Do you think promoters will still be able to pull back and not allow this loan conversion? What is your sense? How much of your NPA problem becomes manageable at all?
No, it's not going to be an easy process. That I fully agree, right? But an enabling provision was required, and the genesis of this whole circular starts about the pricing, at what rate, and particularly in case of a listed company. Unlisted company, the valuation and pricing is not that important. But when you are converting your debt into equity of a listed company, then SEBI guidelines come, and SEBI has issued a notification in May. And that the valuation issue was left to Reserve Bank of India.
Yeah.
So in essence, the genesis of these guidelines is that how do you value, at what value, and that has been very clearly laid down in the...
here they have said that the market value will be the average closing price of the instrument on a stock exchange during the past 10 days preceding the reference date.
Or breakup value, whichever is the lowest.
Yes.
Right?
Yes.
So, like from bankers' perspective and for everybody, every market participant's perspective, the guidelines on the valuation was very important. Because wherever even earlier we found that even if borrower is willing, but in case of listed companies, the valuation was becoming an issue. And that's why there was a request which was made by lenders to SEBI to do something about it and come out with some sort of a clarification where you're not required to make an offer, open offer. You can become an associate if you hold more than. So that is what this entire thing has to be seen in the perspective about.
So you think that you will be able to discipline promoters because this power is there with banks? Is this going to make life any easier for you?
I don't think it changes like anything in terms of balance of power. But what I'm saying is that, yes, it brings more clarity in respect of listed companies about the valuation. Now, whether borrower agrees or not agrees, then lenders have their different options. And when you do an option analysis, then you have to look for the best option and which is the most feasible options and which creates probably a win-win situation for all stakeholders.
Well, we hope that the possibility happens, but win-win for all has so far not happened in most of the cases.
That I agree.
Yeah. Mr. Rajesh Kumar, we have Ashwin Parekh, we have to leave it at